Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And many of you also know me as Mr. Valuation. This video, I'm going to cover 5 stocks that you literally can bank on. In fact, many of you probably are literally already banking on some of these companies. I'm going to talk about the diversified banks, or what I like to also refer to as the money center banks that are in the S&P 500. And, one of the things I've been doing, I've been kind of looking at the S&P 500 as well as other indexes to try to kind of support this theme that I always say it's a market of stocks, not a stock market. And part of the idea here is to give you some perspective, if you will, that's, not all stocks are the same. A lot of stocks are different. You shouldn't think of them all in the same way. In the recent video I did, I covered several utilities, which tend to be low growth, heavily regulated stocks. The banking sector has really kind of a storied past when you look at it relative to what happened in 2008 and 2009 with the Great Recession, which was primarily stimulated by these big banks and the loose money, the loose lending that was going on, and participating in all these collateralized mortgage obligations and even collateralized mortgage obligations squared, where there was so much leverage running around out there in the financial community, and people were being lent money that they couldn't pay back, and the whole thing, we know the story, the whole thing crumbled down. So let's go ahead and take a look at the 5 stocks that I'm going to be covering here today. I'm going to be covering U.S. Bancorp, J.P. Morgan, Bank of America, Wells Fargo, and Citigroup. And, these are the premier banks in the country. They're all investment grade rated. 3 of them are rated A or better, A- on Bank of America, J.P. Morgan, and A+ on U.S. Bank, and then Wells Fargo BBB+, and Citigroup BBB+. And I'm going to go through these banks, and I'm going to go through them quickly. And one thing I do want to mention, banks have very unique financials. A lot of their product is debt. In other words, they borrow money, and then they loan that money as their product. So a lot of times debt is actually inventory for them. And once we get into the Value Academy, when we launch the new version of FastGraphs, we're going to be talking about the 4 different kinds of financial statements that are utilized. Banks and financial companies are one of them. We're going to look at things like REITs, look at things like industrials and so on. So I just want to throw that out to you now because that's something for us to be looking forward to. But let's go through these big banks here. And I want to start by looking at, what these companies have looked like historically, because I think this is very important. I just had a comment on my last article. The viewer said, quit going through ancient history. Don't show me the past. Let's talk about the future. Well, I'm a firm believer that you not only can learn from the past, that you should learn from the past. Because businesses don't change their spots like leopards. They don't change their spots very quickly. If you're looking at a company that has a cyclical history, you need to know that and know that it's probably going to be cyclical going forward. If looking at a company that has very consistent growth, it's probably going to be a consistent growth type company going forward. Now, things like the rate of change of growth might change and things like that, but companies tend to have identities, and those identities tend to carry forward from one time period to the next. Now, prior to the Great Recession, which is indicated here by the dark gray shaded area of 2008, 2009. Of course, it ended in the spring of 2009. If you looked at banks like Bank of America and Citigroup, and I'll be looking at them in a minute, I'm only going back about 5 years here, all the way to 2001 and a little bit of 2002, depending on the fiscal year of the company. And these companies were growing. They were growing you can look at the double-digit growth rates, down here that you see with Bank of America, 19%, 20, a weak year at 7, 11, 12. Everything was going nice. The orange line on this graph is an 11 PE ratio. Okay, so the stock was, following that line. And then, of course, we had the financial debacle. The banks got caught, with significant losses. And I do want you to notice how bad it got. In other words, Bank of America's earnings went from $4.70 in '06 to $3.14 in '07. That was a 33% loss. But then earnings fell 82% in '08, followed by 153% in '09. But then they recovered strongly by almost 400% in 2010 before collapsing again in 2011. So we did have this really smooth earnings record prior to the Great Recession. Then we had this, calamitous collapse. And by the way, if you look at what happened to stock values here, Bank of America, virtually just about lost you 100% of your money. Your stock would have fallen 92.7%. Now, The question is, who would have held for this long and when would you have sold? And that's really a tougher question than, it meets the eye. 2020 here says you should have sold it right away when it started falling, but not very many people did that because this was Bank of America, for goodness sake. Now, I also want you to note something else. If I shorten this time frame, now, by the way, they also slashed their dividend from $2.24 to 4 cents, and they maintained a 4-cent dividend for several years coming out of the Great Recession. But then the dividend has been growing again since about 2014. So the companies are kind of getting their traction back. If I shorten this time frame to about a 13-year time frame, now all of a sudden we're getting an 11% growth rate. But keep in mind, there's some aberrant numbers here. Notice the growth from 2011 to 2012 was 2,400%. The reason I want to mention this is an analytical tool, fast graphs are. And you got to use the tool correctly, and it's an analytical tool, which means you use it to analyze what you're looking at. You just don't look at the picture and immediately draw conclusions. You want to analyze the data that the picture is represented by. Because when I shorten this time frame even more and get rid of some of those aberrant numbers, I start to get something that's maybe more realistic. Bank of America has grown at about 14%. But again, I still have some pretty crazy numbers here. So if I take 2 more years off of this graph, now we're down to 12.37, and that's probably moderately realistic for what the company's been capable of doing after it got over the Great Recession. Okay, now, a couple other things I want to point out, and I'll be pointing this out routinely. The normal valuation of Bank of America has gotten a little lower than historical norms, but having said that, it's recently recovered. So I would consider Bank of America for the short run moderately overvalued. If you were going to hold it for the long run based on consensus analyst estimates, it could be a double-digit returning stock today if it goes, to a 15 multiple from a current blended PE of 19. You could get a nice rate of return, total rate of return, but you're paying a high valuation to buy the stock today, okay? Now, I also want to go somewhere else with this. I want to look at forecasting. So I'm going to be talking about forecasting quite a bit because one of the things, I've been getting a lot of questions, so I thought this particular sector might be a good opportunity for me to get a little bit of explanation about how the forecasting calculators on fast graphs actually work. I think the key phrase that I want to offer here is these are calculators, okay? They're forecasts, number one, okay? So they're not, actuals. When you're looking at the historical graph, everything that's, dark shaded actually happened, and you're looking at factual data here. When you're looking at the forecasting graph, you've got the dotted lines and the light shading, simply to alert you to the fact that you're looking at a forecast here. Now, when you're evaluating forecasts, that's always a great place to start. People argue all the time about the accuracy of analysts, which I'm going to be covering here in a moment. But the reality of it is you have to forecast if you're going to be an investor because you're ultimately going to be rewarded by how well the business that you invest in does, if you're a long-term investor especially. All right, so, you want to come up with some forecast. Now, the consensus of 25 analysts right now believe that Bank of America is going to grow earnings in 2021 at the rate of 39%. Next year, they think it's going to be 12 and 14. Now, these numbers are more normal for what his history looks like. Okay, but I'm looking at a specific earnings forecaster now, meaning I'm getting specific numbers for 2021, I'm getting specific numbers for 2022, and I've got a large universe of analysts doing that. And then when I go out to 2023, my number of analysts drops to 13, but I still have a consensus here. But these are giving me estimates for these specific years. Okay, now another thing about this that I want you to note is that these estimates are dynamic. They change quite a bit. So 6 months ago, analysts were estimating $2.15 for Bank of America's 2021 numbers. And then 3 months ago, they raised it to $2.23, which means they got a little more optimistic about the company. And then the most recent estimate was $2.60, which is what the analysts currently believe. Now, the same thing has occurred for 2022 and for 2023. So the analysts are getting more optimistic about, what these companies are. But now let's look at the record. Now, when we measure the Analyst Scorecard, we measure what the analysts were saying, not 3 months ago or 6 months ago or most recently. We're going to measure the analysts 1 year prior to the actual being released. We want to know what the analysts were saying, and then we do it 2 years prior to the actual estimate being released. So the analyst scorecard isn't dynamic in that it doesn't adjust the closer you get to earnings season. I think that's the key point. Now, if you look at Bank of America, and remember, I'm only going back to 2009 here with this data, I also want you to take into consideration this is the Great Recession stuff, okay? And this is when the financial companies were just really getting beat up. But bottom line is, when I look at the one-year forecast, analysts were missing this, not just by a little bit. We give them a 10% margin of error on a one-year forecast. They were missing it by 700%, 14,000%, 284%. In 2011, analysts were expecting $1.50 and the company only earned a penny. And then the 2-year, when they were making estimates 2 years ahead, they were also abysmal. So when I look at this from a summary point of view, analysts have not been very good at estimating Bank of America's earnings more recently. Now, having just said that, they have gotten a little bit better more recently. Okay, so let's go ahead and look at that. The numbers, going through the Great Recession and so on were abysmal, but more recently, since 2016, they started to get it right until COVID came along. And then COVID threw a ringer in the spokes again, or a wrench into the spokes again. And so these companies have not been easy to forecast more recently. Now, why is that important is because when I'm looking at the forecasting graph and I'm seeing what these analysts are expecting, I do want to consider, number one, that they haven't been very good at forecasting these banks here recently. So, how much credence I put in that, just because the analysts are saying it, I don't put a whole great deal into it. Another thing I want to point out, when you're looking at historical data here, this was COVID, okay? And these guys had to, accelerate their loan reserves and so on. So their earnings, you'll see it across the board here, virtually every one of these companies took an earnings hit, or taking an earnings hit for this year because of what they had to do in response to COVID. In fact, they've just been released to be able to start buying back shares again because, they were being forced to hold higher loan reserves, at least temporarily, because no one knew what COVID was going to be. But so the point I want to make is, though, this 39% growth rate expected for 2021 is actually a reversion to the mean. In other words, if I took this here and just kind of drew a line straight across, that would be what normal earnings would have theoretically looked like had COVID not come along. So the reason you're seeing such a high number here is not because all of a sudden the company's growing like a weed. The company is simply returning back to more normalcy, back to their innate earnings power, if you will. So I want you to consider that as you're looking at each of these companies. All right, so I'm going to go to the next one. I'm going to go to Citigroup here, and I want to go back to that long-term graph and let you see that Citigroup was rolling along real nicely. Their recessionary numbers were even way worse than Bank of America's in that their earnings collapsed 83% and then 765%, if you will, to where they actually lost $47.90 a share in '08, which was, almost 100% deviation from what they were earning just a few years ago. But now as we look at the company since it's come out of the Great Recession, if we look at what's happened more recently, it still has the cyclicality or some cyclicality, but I do want you to note that, the earnings have been, growing at a pretty healthy 8% rate, and this stock only trades at a blended PE of 12. But here's a case where, beaten up so bad after the recession, the market has been punishing this stock with a low valuation, if you will, for the last several years. Notice the blue line is a PE of 11, and these numbers are always this. They call that a 10 to 12 PE. The market's valuing that versus a normal PE, where the market would have been valuing these stocks at, 15 to 18 times earnings or higher. Here you can see, back here the PEs were 15, 16, 17, and then down here we saw PEs of 7 and 8. So, the markets do have a memory, because people have asked me that recently, but the bottom line is, they're valuing these stocks based on a pessimistic viewpoint. What's really going to happen going forward? Now, I'm going to go back to the forecasting tool. When you use the normal multiple, we're going to draw the fair valuation reference line at a PE of 11 because we're using the 5-year historical normal PE, okay, as simply a default and a benchmark. But I can use this drop down and I can look at what normal PEs have been for this company historically, and I can even pick and choose. If I wanted to be optimistic, I could put a higher PE. So I'll change this 11.2 to a 13.33 PE right here, and I would do what if. But I want to go back to something. This is a calculator. It's simply saying if these numbers come to pass and the stock trades at these valuations, this is what your rates of return would be. It's not a prediction. It is a calculation. It allows you to make a rational calculation based on expectations, at least by the consensus of analysts following the company. And again, we've got a lot of coverage on Citigroup. Again, here's what I want you to note. The numbers here, the earnings estimate, 749 or 59 is the same on that blue graph as it is on this brown graph because we're using the same consensus data here. So even though there are two different estimators here that are giving you two different valuation references, one based on the normal PE, which sometimes is more appropriate, as I think it is in these financials, these banks case. Other times we would use a formulaic fair value number, and you're going to get different results. But you as an analyst, if you're analyzing the stocks using this tool, have to decide which of those you would rather trust. In this case, this number is obviously more conservative than this one. Here we're looking at a rate of return of over 100% by next year if it reverted to a 15 PE. With the normal multiple, we'd still be looking at a very attractive 61% rate if it only traded at a 13 PE. Okay, but those are simply what-if calculations. Now, the next calculator, and I want to spend some time on this, is a totally different forecast. This is simply using a 3 to 5 year trend line growth rate. Now, first of all, note there are only 3 analysts in the case of Citigroup that are making this forecast. And they're saying they think the trend line growth over the next 3 to 5 years is going to be approximately 24%. Now, I can check a lot of different sources. I can go to Yahoo estimates here right directly from FastGraphs, and I can go down to see what Yahoo is. Yahoo's group, they get from where they're saying only 1.28%. Now, that's a big red flag because that's a vast difference from what I'm seeing here. But I can go look at, all kinds of other sites and try to get earnings forecasts and come up with a lot of different numbers. These are calculators, ladies and gentlemen. It's whatever the numbers are showing is what it is, but don't count on this as being a prediction. This is a different estimate than you're getting on these two graphs here. Okay, and it can be used differently and should be thought of. This is more trend line. Really, when you're using this particular forecast, or those of you who subscribe to FastGraphs, here's where you're really focused out here 3 to 5 years, which is a stretch anyway when you're making forecasts. When you're using these forecasting calculators, the closer you're looking is more likely to be more relevant, more apt. Okay, and then we have a third forecasting tool, if you will, called the historical growth rate. The immortal Ben Graham talked about the fact that, you should, instead of using analyst estimates, use as your forecast the average of the company's last 3 years, and in some cases he said the average of the last 5 years. So what we're giving you here are companies' historical growth rates. Now, again, we default to the 5-year growth rate, and the 5-year growth rate for Citigroup, if you go back and look at this graph. Now, I would have to draw this as a 7 or 8 year graph, by the way, to get 5 years, and then I would have to scroll out all of the forecast data here. I want to be clear about that. I didn't get it just right here because what I'm looking at is only the last 5 years. In other words, this data on this graph does not include any forecast, where when I'm actually in the historical graph and I'm measuring things like 5 years, or in his case 8 years, I am including what they're saying to be estimates. I just want to be clear about that. But the point is, using this calculator, I'm using historical growth rate. Now, I've got a drop-down window here. I can say these numbers are kind of crazy for Citigroup, and they're obviously tainted by COVID. So I might want to say, what's a more realistic number for Citigroup? Unfortunately, I don't really get one. Now, I could be real aggressive and use a 14% number. And then this simply allows me, if it grew at that rate, what would my numbers be? Or I could be real pessimistic and I could stick with this negative number and saying, Citigroup could be a really lousy investment for the next 5 years if, these forecasts turn out to be correct. It's a forecasting tool and it must be utilized correctly. That's my whole point here. The next stock I want to go to is JP Morgan. Now, JP Morgan is a little more diversified than Bank of America and Citigroup were. They suffered. They participated in the lavish lending practices as well, but not nearly to the extent that Bank of America and Citigroup did. They did have an 81% drop in earnings, and they did cut their dividend from $1.50 to 20 cents, but also notice that they started growing that dividend again much quicker. Now, if I look at the history of this stock, it's actually got a much better growth rate. Again, COVID is kind of your aberration here. I think without COVID, we'd have seen a smoother number. So once again, we're looking at a 44% earnings increase, and you'll read that if you go anywhere, into the statistics on these companies. Let me see if I can do it. If I go into, let's say, Google Finance, I might get a thing where it says, if I go to earnings, it says, they'll say that, the company is expected to have really high earnings growth. I just didn't happen to find it on that one. Maybe if I go somewhere like, let's go to Seeking Alpha, because they always talk about earnings here, and I can go into earnings here, and, they'll talk about, what they expect the company's earnings to be. In fact, I can also look at earnings estimates here, just like I did in Yahoo Finance earlier. And, you can see that they're expecting a big number in earnings growth as well, year-over-year growth of 31.8%. So, it's consistently across the board, but it's not precise across the board. Not everybody's agreeing. That those Standard & Poor's guys at Seeking Alpha are getting different numbers than what I'm getting on FactSet. But the point of the story is this again is kind of a reversion back to their normal innate earnings power. So that's a big number, but it's really, it's really coming off of such a low base here. That's what I want you to get. And once again, when I'm looking at forecasting here, I'm looking at a stock that looks pretty attractive on the estimates. The normal multiple, it doesn't look quite as good, but still gives me double-digit return potential. In this case, the longer-term growth rate is expected to be 10%. And again, if I check that with someone like Yahoo, I might get something, considered, but Yahoo's only saying 1.28% again. So these guys at Yahoo are really kind of tough customers, I guess. They're not willing to give these banks any credit at all going forward. But that's something you as the analyst have to take into consideration. The calculator is once you put the data in, then you can easily run calculations. And that leads me to the custom calculator. With the custom calculator, you can input your own earnings, you can put in your own growth rates, you can put in your own PE ratios, you can put in your own dividend rates. If you have different opinions of what these analysts are, you can then use this. But once you do it, you're just doing a forecast again, just like these guys are doing when they're doing these numbers here. Okay, and again, I want to point out that the analyst scorecard on these companies is not great. Now, JP Morgan has a better scorecard than we saw with, I think it was Bank America that I showed you earlier. All right, the next one I want to go to is U.S. Bancorp. It also has a better record. U.S. Bancorp and J.P. Morgan, I think, are two of my favorites, and I actually like them the best as banks. I don't own any banks right now. I do own some Canadian banks. I'll take that back. But I've been reticent to invest in these guys because of what happened during the 08-09 recession. But U.S. Bank held up, and it is the A-plus rated bank in the group. It was much more prudent, and it handled that financial crisis much more prudently than some of those bigger, even more famous and more popular banks did. So I do want to throw that out. Now, next I want to go to Wells Fargo, and this is my last one. Now, this is a bank that I owned. I invested in Wells Fargo coming out of the Great Recession because it, as I said with U.S. Bank, it came through the recession and the financial debacle a lot better than most of the other money center banks. And I owned this stock until 2016, which I then decided to sell out. If you all recall, they had the fake account scandal. Okay, and the fake account scandal really tarnished their record reputation. I didn't feel comfortable any longer investing in a company that, had that kind of a management track record. So I sold out. The stock actually rose a little bit right after I sold out, but then it's recently collapsed, but now it's recovering again. This is loan loss reserves because of coronavirus and because of that, scandal they had. They actually got hit a lot harder. Now they're expected to have, going back to this reversion, if you will, or, the stock simply recovering back to more normal earnings power. It's expected to have a 794% number. Now that number would be startling, if you're reading it in a headline, but you got to have it in the right context. That number is only a big number because it's coming off of a 41-cent base where, a year ago it was earning $4 and, a couple of years ago it was earning over $4 a share. So that's a significant drop in earnings. It's now expected to come back to $3.67, which is still below what it was earning just a couple of years ago. But that recovery is, again, coming off of this low base. Now, when you look at the forecast here, this one looks a little shakier. Again, the analyst scorecard on this company is actually a little better than most. It actually did real well. But then again, the 2016 was when they had the scandal, and then what I mentioned with COVID. So as I'm looking at, Wells Fargo, I've decided I personally don't want to be there anymore. The question is, are you willing to forgive them or not? Because the company does look like there's an opportunity to make some money in it going forward if, it returns back to its historical profitability. It is expected to grow very fast, faster than any of the others going forward. But again, that's all to be determined. So anyway, when you're looking at these companies and you're using this fast graph tool, for those of you that are, remember it's a tool. Forecasting tools are calculators. Okay, none of the, I would argue that none of these numbers are likely to be perfectly correct. The question is, are they going to be reasonable? Are they going to be rational? And also, I want to remind you that the forecasts are constantly changing. You can see here that for 2021, Wells Fargo went from an expectation of 210 to 238 to 283, and now the analysts are saying 367. So you've also got to stay on top of these things. Anyway, I hope you learned a little bit about using the fast graph tool. Hope you learned a little bit about diversified, or what I call money center banks, part of the S&P 500, and I hope you got a little better perspective of what's happening with their stocks and their stock prices. It's been Chuck Carnival saying thanks for watching. And again, if you like this video, give me a like, give me a thumbs up, subscribe to my channel, ring bells, do all those things that, help me and help you get more content like this. Thanks for watching.